Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I'm your host, Jeremy Dyer. I've got another wonderful, amazing guest with me today. I have Robert Rolih. Robert, welcome to the show.
Thank you for inviting me. It's a great honor to be here.
Yeah, absolutely. I'm looking forward to chopping it up with you. So Robert is on a mission to expose what the financial industry does not want you to know. Robert has guided tens of thousands of investors in 73 different countries now grow their wealth by avoiding, get this, by avoiding Wall Street traps. Okay, so this is going to be a fun episode here, Robert. Really looking forward to, chopping it up with you here. But before we kind of jump into, Wall Street traps, I would love for you to let our audience know a little bit more about yourself, your background, your journey, what you're focused on today, etc.
Yeah, I grew up in a backwater village in Slovenia. This is a tiny country near Italy. And at the time, it was still a part of the communist bloc. My parents were blue-collar workers and money was always in short supply. I can still remember my father. He was a tough guy with this Jimi Hendrix hairstyle. He was always saying, Robert, we don't have any money. We cannot afford it. And then when I was a student, I started my own business. Uh, After 5 years of hard work, my company started to produce a lot of profits. And at that time, I knew that I should invest, but I was totally financially illiterate. That is why I trusted financial advisors and investing gurus. And after years and years of giving them my business profits, my wife, Sarah, said, Robert, I know that you trust these guys, but let's just check, where we stand. So I asked them to send me the reports. And when I opened these envelopes, it was like, are there some zeros missing? Money that I worked hard to earn was mostly gone. And that was a big, big, big shock for me. I was working hard, giving my business, everything that I got. And in the end, I lost most of my money. So it was really a big, big, big shock for me. And that led me to start exploring what is happening in the investing world, what is happening behind the scenes of the Wall Street, and why I lost all that money. And maybe, I was even lucky because that was the foundation of my current business. Because right now I'm educating investors all around the world how to invest without the help of the Wall Street, how to get much, much, much better returns compared to returns that they could be making with the help of their financial advisors or Wall Street gurus and so on.
Yeah, no, that makes sense, and I appreciate that background. I know you've said before that people or investors, they don't lose money because of bad markets, rather they lose money because of bad decisions. Can you maybe elaborate a little bit more on that?
Yeah, the most important decision that you can make is what kind of financial products will you invest into. If you invest in the most popular products, these products are usually the worst ones for investors. Now, why? Because they have the highest possible fees. So if some products are very popular and if everybody is recommending them, this usually means that they have a lot of interest to sell you these products, and usually this means high fees. And when you account for these high fees over a long period of time, the numbers are just staggering. you can lose a lot of money. And this is also the main message of my book and everything that I do, that even a regular investor, someone investing just maybe 3,000 or 5,000 or 10,000 per year, can easily lose over $1 million by the time they retire because of these hidden fees. The financial industry calls these fees management fees, and they don't look dangerous at first glance because it's just 1% or 2% per year. But over time, they quietly compound against you and rob you of your financial freedom. So this is the main message. This is the main decision that you can make. How much will you be paying in fees for your investments? And the lower the number, the better it is for you.
Yeah, that makes total sense. I mean, I've heard some financial advisors say over time that some investors may lose 40 to 50%, of their gains to these hidden fees over the course of their lifetime and not even know it. I have not read your book yet, Robert, The $1 Million Decision. I will absolutely take stock in that book for sure. But I know that there's a principle that you teach in that book called the six dark forces of investing. I assume that fees are one of those dark forces. Maybe what's one other one in your book that really is damaging to investors right now in the current, state of the market? And why is it so hard for people to sometimes see or recognize some of these dark forces?
Yeah, the first dark force we already covered, like we said, this is about commission. I call this the commission camouflage effect. So where small annual fees seem harmless, but over time they eat a massive portion of your returns. Now there are five more, and the one that I see right now is the lure of the shiny next big thing. For a while, it was AI. Then it was quantum computing. You have these teams, these shiny objects that investors want to reach. But when they start talking about them, it's usually too late. Okay. So, for example, quantum computing. When it became very popular and everybody started to invest in quantum computing, the stocks then crashed. And it's the same story with most of these shiny objects. They seem amazing, but usually the crowd is getting into these shiny objects when it's already too late, when they are already picked. And this is for example, also gold right now, or silver. Everybody's talking about gold and silver, but I think it's a bit too late to invest in gold and silver right now. Right now, I'm cashing out of gold and not investing in gold. But I was investing in gold 2 or 3 years, prior to that. So right now, I'm cashing out. But most people right now, they are starting to invest in gold when the prices already went up 150%. So yeah, this is
Yeah,
the one.
it makes total sense. I mean, this is really, we're talking about human psychology here, right? People over speculate, people make investing decisions based upon emotion when they think they're making it based on logic and fact, right? Usually when people are running into the fire, that's the time to be running out of the fire, kind of a thing. So,
And vice versa, if I can say. For example, when there are great opportunities to buy a certain asset class or investment, most people don't see this as an opportunity because they are in panic mode. For example, in 2022, Bitcoin fell from 66,000 to 16,000. It was a huge drop, 77% drop for Bitcoin. And at that time, Jim Cramer, a famous TV host on CNBC, he was telling investors, get out of Bitcoin while you can, because he was saying, Bitcoin is going to zero. That was the moment when I was heavily buying Bitcoin. And I even wrote an email to all my clients, and I said to them, I'm buying Bitcoin heavily. And I showed them the screenshot of Cramer saying this, get out of crypto, and said, Jim Cramer is an amazing contrarian indicator. So now I'm buying heavily. And that was a great decision, because Bitcoin later went to 120,000. So that's like 600 or 700% return. So yeah, this is this is the story of how most investors think and act. They are buying or selling at the wrong moments.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I'd love to get your perspective on something, because the average busy professional, I think, really struggles between, making their own investing decisions and over delegating to financial advisors. So what would you say is kind of that right balance that busy professional should really strike, that doesn't really have time in their day to become over obsessed with the markets, right?
Yeah, yeah. You
What's
should
that
never
balance?
be watching the news. You should never be following the markets too closely, because most of this information is just noise, and your decisions will be worse if you are constantly looking at the charts and listening to media and so on. So it's best to stay focused on the long term. And I think that most investors would do best if they just stick to stock ETFs. These are basically big baskets of stocks. So if you just invest in stock ETFs, if you invest in big baskets of stocks for the long run, so this means at least 5, 10, maybe 15 years, you will outperform like 95% of investors, because most other investors are constantly getting in and out of market. They are speculating, they are making wrong decisions, they are getting scared when they should be investing, and they are selling when they should be buying, and so on. So for most investors, especially if you are a busy professional who doesn't have time to follow the market and so on, it would be best to just stick with stock ETFs, invest regularly, and have this long time horizon, and just follow your plan, and that's it. Most of the time you should be sitting on your hands doing nothing.
Yeah, no, I appreciate that perspective. And I know that you have really advised that busy professional type individual, which a lot of them listen to this podcast on a regular basis. You kind of claim that wealth can actually be built in as little as 1 hour per year. So can you walk through what that 1 hour typically looks like for that busy professional?
Yeah, so one thing is regular investments. For example, if you invest once per quarter or maybe once per month, depending on your income, of course, you just need to regularly invest. This is called dollar cost averaging. So regularly invest. This takes almost no time. And then when there is a crisis, when there is a panic in the market, for example, Trump tariffs scare in March and April 2025, markets tanked in a very short period of time. Markets tanked 20 to 30%. And at that time, again, this was like, oh, thank you, thank you, market. I was heavily buying, and again, I was sending emails to my clients. I send them free emails. I'm buying now. I'm buying now. This is a great opportunity. So first, you should be regularly investing, and then I always keep some money on the sidelines if some kind of situation like this happens in the markets. And then I, of course, place this money in ETFs or sometimes Bitcoin, depending on what is happening, and which asset class I think will do great. So stock ETFs are always evergreen investment. You cannot go wrong with that because our countries will print money also in the future, even more than they are doing it today. So if you have more money in circulation, all these asset categories will go up in value. Stocks, real estate, Bitcoin, very likely, and so on and so on, gold and so on. Stocks are evergreen investment. And then you need to be a bit careful when you invest in Bitcoin because Bitcoin has a very, very high volatility, and it has these cycles. For now, it looks like Bitcoin is still following this 4-year cycle. So right now I'm out of crypto. I'm out of Bitcoin. I cashed out everything several months ago when Bitcoin was around 120,000 and 106,000 and so on. But now I'm preparing, for new opportunities, and I think that maybe some good opportunities will happen in the second half of 2026 for Bitcoin. But we will see. You never know with these things. There are only probabilities and no certainties in investing. I always keep some cash on the sidelines, not a lot. I don't keep 50% of my portfolio in cash because that would be too much, too much. But maybe 5%, 10% you can always keep in cash just to grab these opportunities that happen from time to time.
Yeah, it makes total sense. Obviously, it's good to have dry powder on the sidelines to take advantage of opportunities where market cycles might impact, price of assets and stocks and crypto and things like that. I know that the financial advisor community, I know that the average sane individual would say that diversification is prudent and responsible, but I also know that. While that might sound responsible to most people, sometimes diversification can quietly sabotage returns. So I'd like for you to maybe kind of explain, why you feel that way.
Yeah, this is a good observation. So, for example, if you are investing in stock ETFs, you are already very well diversified because you are investing in all sorts of industries. You are investing in all sorts of companies, new companies, or maybe disruptive companies. Some that are already cash cows, and so on. So if you just stick to ETFs, stock ETFs with the biggest part of your portfolio, you are very, very well diversified already. And then you can just add some Bitcoin from time to time. You can add some gold, maybe bonds when you are a bit older. For example, I'm not 50 yet. I will be 50 soon. But I'm not investing in bonds right now, and I don't think I will invest in bonds for the next 10 years. Why? Because I don't see myself to need my invested money in the next 15 years or so, or maybe 20 years. Or I will only need that money maybe later when I am 70, 80 years old. And for example, diversifying into bonds right now would be counterproductive for me because if we take a look at 10 or 20-year period, it's almost impossible. Everything is possible, but the probability of this happening is close to zero. That bonds would be outperforming stocks over the next 10 to 20 years. So that is why I'm not investing in bonds yet. But maybe when I will be 80 years old, yeah, sure, I will put part of my portfolio into bonds, because they are very safe asset class and so on. So yeah, it's like I said, even if you are just investing in stock ETFs, the diversification there is already very, very appropriate for most people. And you don't really need a lot of other stuff in your portfolio, especially because if stocks will not perform in the next decades, this would mean that something is seriously wrong in this world. That it's like the end of the world or the aliens invading or something like this.
Yeah, that makes sense. I would love to get your perspective on something, and I'm going to try to frame up this question as best as I can. I'm mostly a real estate investor. And when it comes to real estate, we talk about something called organic rent growth, okay? Which a large percentage of organic rent growth in real estate is really a direct byproduct of the inflation monster, right? The deteriorating value of the dollar, right? That manifests itself in what we call organic rent growth. I would love to hear maybe your perspective as to the impact of the indexes like Dow Jones and NASDAQ and S&P, right? What percentage of those increases, okay, in those index funds can actually not be attributed to company level performance and profit, but actually the deteriorating dollar or
Yeah.
inflation?
Yeah, that's a fact. US dollar and every other currency, it's losing its purchasing power over time. Sometimes quicker, sometimes a bit slower. But the reality is that if the one thing is the official inflation, that's like 2.7% now. It can be 3%, it can be 2%. It doesn't matter. But the real inflation is much, much, much higher. And of course, this affects all asset categories. And if we take a look at S&P 500, S&P 500 had approximately 10% annual average growth in the last, let's say, 100 years. So historically, and of course, around 2%, 2 percentage points out of that is inflation on average. So it's like 8% is companies growing and becoming more profitable and so on, and 2% is inflation. So this affects all asset categories, and it will not stop because our governments are in debt. These debts are increasing over time. This will not stop because our politicians just spend. And this is the fact of life. And that is why I'm saying you need to be invested. You cannot leave your cash under the mattress for a prolonged period of time because this money will lose its purchasing power. Yes, you can have some money on the sidelines for, I don't know, 3 months, 6 months, maybe 1 year, but not for 5 years, not for 10 years, because inflation will destroy the purchasing power of that money. So
Yeah.
this is a fact of life.
Yeah, that makes total sense. If you could, Robert, if you could leave our listeners with one rule, okay, just one, that would protect them from 90% of the investing mistakes over the next 20 to 30 years, what would that one rule be?
So apart from that, apart from the commission stuff that we already talked about, so keep your fees low. So keep your commissions and fees that you are paying low. Ideally, these commissions and fees should be below 0.2%, okay, annually. Apart from that, just one thing: keep things simple. Okay, don't overcomplicate investing. Um, One of my quotes from my book says, investing is simple. It's the financial industry that works hard to make it complex. And this is because if you feel that investing is complicated, that you need help, that you need all sorts of advisors to help you, this will become very, very expensive for you over the long run. So keep things simple. I would say most of your portfolio should be in a simple stock ETF, low cost stock ETF, and that's it, So if you are just doing that, you will outperform most investors out there. For example, my wife, she is simply investing in two ETFs. One is a global ETF and one is technology ETF. And her results are much better than Warren Buffett's results since she started to invest in the last 10 years or so. So yeah, you can outperform 95% of investors by just following this simple strategy.
Yeah, it makes total sense. Keep it simple when it comes to investing. I love that, Robert. Well, this has been a tremendous discussion. I've really appreciated the value that you've brought us today. What might be one or two different ways that our listening audience can connect with you to learn more about what you're up to, outside of course, grabbing a copy of your book, $1 Million Decision?
Yeah. So the best way would be to just go to my website. It's my name and surname.com. So robertrolih.com, ROLIH.com. And there I also run every couple of days. I run my free masterclass for long-term investors. It's totally free. And I cover how to invest in the age of excessive money printing and AI. So yeah, it's a great masterclass, like 90-minute masterclass, and you can always join for free on my website.
That's great. Well, we'll definitely put that information in the show notes for the episode. Robert, again, really appreciate the discussion today. Thank you so much for your time.
Thank you for inviting me. It was great. Yeah.
Absolutely. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.